Welcome to Tutors of Life podcast, where we research life so you don't have to. Episode 289. This is your host, Shaun Tutor.
And this is Sam, and this is a tutor episode where we try to teach you something new.
All right, gang. So as we know, I deep dove into whole life insurance.
You did?
Because I wanted to know if it was worth it. Because I was getting spewed some information about whole life insurance. I don't even remember where at this point. But it seemed too good to be true.
Mm-hmm.
It was like, this is fucking God's nut right here. And we are all idiots for not doing it. So we dove in head first to figure out if it's worth it. And to figure out the intricacies and all that fun stuff. And let me tell you what we figured out.
Don't ruin the surprise until the end.
Exactly. You will figure out what we want come the end.
As we go along, you can make your own opinion, and we'll tell you ours at the end.
So first, whole life insurance is not an investment.
Mm-hmm.
It is a life insurance policy with a banking proportion, banking capabilities.
Mm-hmm.
So you have two things you buy. You buy a death benefit, and you buy cash basis. Okay?
Oh, do you want to say where you got your information from?
So I've got a bunch of information from Becoming Your Own Banker, 5th edition, Unlock the Infinite Banking Concept by R. Nelson Nash.
Mm-hmm.
And then I also met with a salesman who will be speaking in Wisconsin. Great guy, a lot of good information. He helped me out a significant amount because the book leaves some things unanswered.
Mm-hmm.
The book leaves some things that are questionable that I had to go ask an agent about to get actual answers on, which was good to find out. So essentially what it is a whole life policy compared to a term life. So term life, you get a 10-year, 20-year, 30-year, usually term policy. So say for a life insurance policy, easy math, you're looking for 10 times your annual income. Okay? You make $50,000 a year, you want $500,000 in life insurance. Or not necessarily life insurance, that much in assets or whatever. Does that make sense?
Mm-hmm.
So let's just say, the idea is, you do a 10, 20, or 30-year life insurance because in 30 years, in theory, by the time you go to retire, you shouldn't need life insurance anymore because your house should be paid off. You should have paid off cars. Everything should be paid off so you don't have a big overhead for your significant other to cover because you're already living on your retirement because you should have been responsible enough through the whole time that you didn't need it, right?
Right.
So that's the idea behind term life. Now, whole life, you have a similar thing, life insurance, that builds up, and it's based off of 100 years. So you no longer have to pay into your death benefit when you equal your death benefit pay-in. So if you have, I don't know what it is, whatever, but after 20, 30 years, you no longer have to pay in because you've already paid in your amount of death benefit or whatever, right? So that is for your whole life. So it's not for a certain term. It's for your whole life, and that's why it's called whole life insurance. And so if you can have this policy into 90 years old, 100 years old, 110, it doesn't matter. If you die, that death benefits gets passed to your kids or to your, not necessarily, whoever your beneficiaries are. So if you're in really good health and you're at 20 years old, you can lock in a life insurance policy at 20 with the same premiums until you're 50.
Mm-hmm.
It'll be fully paid in, everything at 50, and your beneficiaries will get your death benefit whenever you die, right?
Mm-hmm.
Where term, it's done at 50 and it's over.
Yeah.
And if you had to re-get insurance at 50, you're probably not going to be in that great a shape. Or you won't be in as good a shape as when you were 20, most likely. And so you're going to have
because the premiums
high
go up.
premium significantly as you
Yeah.
get older, based on health and age.
Yeah. Even into your 30s, it went up quite a bit.
Because if you do a 30-year in 30s and you're dying in 60s is a lot more reasonable than dying in 50s.
Yeah.
So, pretty. So that's kind of your two things there, right? So the thing is, if you're going with term, I'm gonna just break this down in layman's. If you're going with term insurance and you're gonna actually save for retirement, you're gonna do things how you're supposed to do, etc. Term life insurance is a good ticket, right? If you're gonna be a piece of shit, you're not gonna save any money. You're not gonna be responsible, whatever. Whole life insurance might be your ticket, so you're not leaving your beneficiaries with a bunch of bullshit debt and everything to clean up. Does it make sense?
Yeah.
Okay, cool. So, about this, so you have your death benefit, which gets paid in. That's your death benefit, whatever. That's like your premium, right? Whatever. And then you have a cash basis portion, okay? That goes into your cash basis. Your cash basis is your bank account. Your bank account grows dividends, okay? Average dividend is 3 to 4% over the last 200 years.
A year?
A year, 3 to 4% over the last 200 years a year. There was something this morning in 1982. They introduced something else which fucked up the dividends and stuff. So as of 1982, the whole life insurance used to be a staple. Everyone, like, whole life insurance was the biggest investment, the biggest insurance, everything. Until 1982, they came out with some sort of law which really affected this. So, like, reading books and everything, and seeing, like, reading Napoleon Hill's books and stuff, and seeing the life insurance, it's not all the same now because something happened in 82 where it changed, and that's when a lot of people started getting off the whole life bandwagon. So that would make sense, because I was like, what happened? Like, why did everyone quit doing this? Why did it become a bad guy?
Right. Because, yeah, I mean, you read a lot of older books, and they all talk about whole life insurance, how you have to have it.
Yeah. Oh, yeah. So let's go into the quick things. People love whole life insurance because you can be your own banker. If you're an investor or whatever, you can be your own banker. So if you're just doing, like, your minimum payments or whatever, it usually takes like 7 years minimum, but 10 to 20 years for your cash basis to have any sort of, like, anything to lend out of, right? So it's a very short, long game if you're not going to do something called PUAs, paid up additions, okay? So paid up additions, what you can do with paid up additions is you can pay in up to 10 times the amount of your premium. And your premium's your death benefit. Okay, so if your premium is $10,000, so $10,000 a year is your premium, you can put in $100,000 into the policy. Your first, like, right when you sign up, boom. By doing that, now you unlock that amount for cash basis. So right away, it takes like 1 week season, but like day 8 or whatever, you can start using this as your bank, okay? Now, here's where things get a little tricky. 2 areas here, okay? So your yearly premium, depending on how you set up your life insurance policy, there's 2 portions, your death benefit and your cash basis, okay? And so you just think, okay, 10x of my premium. Okay, well, they recommend splitting 50% to cash basis, 50% to premium. So you'd really be paying in $20,000 a year, because $10,000 would be going to cash basis, $10,000 would be going to premium, making it $20,000. If you wanted to get $100,000 put in, you have to do at least $10,000 into premium, which is your, like, basis start out. Does that make sense? So when I'm saying 10x your premium, you're not having a $10,000 yearly payment. You're having a $20,000 yearly payment with a $10,000 death benefit. Does that make sense? Okay. So we have that. And then people think, okay, so I'm paying in $20,000 a year, and this is something that really got me, like, whatever. I am lending from my bank account, right? I'm pulling from my bank account. The biggest misconception, this is what I finally figured out after a lot of this, is, so they say it's your own bank account, but why it's so much better than a normal bank account is it continues to grow interest or dividends on your money in your account even while you have the money loaned out. And I'm like, how does that make sense? And then they say you can set your interest rate to pay back. Once again, I'm like, what do you mean? So I'm like, okay, well, if I set my interest rate at 8%, the standard, and I'm getting 3 or 4%, I'm getting a 12% return on my money. This is where I was like, this is a no-brainer. What am I not understanding, right? This is what we finally figured out. You do not loan, or you don't take money. That is not your bank account. That is collateral. You take a loan from the life insurance company, okay? So you're taking a loan from the life insurance company, and your whole life policy, your cash basis, is the collateral. Where I thought you were taking your own money. That's not what it was. So, okay. So, yes, your collateral staying in there growing at 3.5%. I'm going to say 3.5% because the average is 3 to 4. So 3.5% is growing at. Okay, cool. The insurance, so you can pay it back at whatever interest rate you deem is necessary. Here's what they leave out, and this is what, if this is not 100% accurate, this is the information I was provided. Because it does not break it down in the book. You get to set your own interest rate. However, they charge 5%. Or their average is 5% because it's 2 points, 2% over whatever you're getting in yours, right? So they're making a 2% spread no matter what on the money they're loaning out, right? Where they say you get to choose how you pay it back, and you get to choose if you pay it back, you get to choose the interest rate you pay it back, etc. They will take your 5% or your interest payment that you owe them out of your cash basis. Does that make sense? So you're going to take it out of your cash basis so they can keep paying that. And so you can like cruise and not actually have to pay it or whatever, right? Because they'll just take it from you.
Yeah.
Now, where they say, and this is how they get it to like sound so beautiful, but it's not, is they say you make the interest rate. So you should never rob Peter to pay Paul. You should always be paying yourself back at the current rate or more. So, okay, so let's say I'm getting 3.5% dividend. Okay, awesome. That's staying there, right? 3.5. I take a loan out, and I'm going to pay that loan back at 8% because that's what market value is, okay? The way it was explained to me originally was I'd be getting that 8% plus the 3.5, 11.5%. No. You're paying in the 5% to the insurance company, then you pay the other 3% into paid up additions of premium into your account, into your cash basis account. So you're getting 6.5% positive, but losing 5%. So you're coming out positive 1.5%. Of course, you were paying 8% of the interest, and 3.5 was what was growing. And so you actually come out net positive on this 1.5%. So that is like probably the first biggest like misconception or whatever of the whole policy is you can set how you pay it back. You can set your interest rate. You can do all that. But it's not a loan out of your account. That's not your money you're taking. you're borrowing that money at 5% or, the percentage that they deem from the insurance company. And if you're not paying it, they're taking it out of your policy. And then
you have to make monthly payments on that loan.
You have to make, yeah.
Yep.
And I think from my discussion, your dividends are yearly dividends. So like your dividends you get are yearly, but you're paying monthly interest. See what I'm saying? So it's not as juicy. Where like certain high yield savings accounts and things, you get monthly dividends or monthly interest payments. So the first part about this whole thing is there's two portions. You have a death benefit and you have a cash basis. If you want to do paid up additions to put more money into the account to fund it, to start using it as a collateral for banking, then you can put up to 10 times the amount of your premium. Okay? Then, when you have that policy, you do not loan your money out. It is collateral, and you're getting a loan from the insurance company. You have to pay the insurance company a monthly interest rate. And then the idea of not robbing Peter to pay Paul is you're paying whatever excess. So right now, his current market is 3%. You're paying that extra 3% into paid up additions into your policy, into your cash basis, to increase that to make it seem like you're like getting more money. So after the whole thing in today's current market, you would be 1.5% ahead. Okay. So that's the first portion. Let me pull this up. All right, so something that we wanted to see. So taxes. Why this policy can be nice as well as taxes. Okay, so you don't get taxed on your money in the account as long as you follow the rules. As long as you follow the rules, I started saying and like whatever. There's no tax issues, and that's because the amount of money you pay in and the amount of money that is taken from you in fees, commissions, death benefit, counter fees, assistant admin fees, etc. Your dividends, so your gains, it typically takes 100 years for that to be a break even. It takes like the 100-year policy or like your age. So like it's based off 100 years of age. So if I get it at 30, it would take like 70 years before I would start getting taxed on that because that's like the length of time or whatever. Does that make sense? So at least that's how it was explained. That's how like what I got out of it. But so the reason that you're not getting taxed on the interest payments is because of the amount of money you already paid in, but what was taken from you in like fees and commissions, etc. And then it's also not taxed because it's a private contract with the insurance company. Okay, whatever. Interesting. Tax deferred as long as we did not reach the amount of money we put in. That's withdrawing complete. Yeah. So, other option when you reach the complete amount of money you put in, don't pay it back and lend it out as a loan. And then when you die, that loan just pays itself back. So there's an annual dividend. And with the annual dividend, they recommend, or like the thing they do is they buy more life insurance, more premium. I'm like, why would I want more life insurance? I don't need $5 million in death benefit. Give me more cash basis. What? It doesn't make sense. They just buy more life insurance. What I've noticed is insurance, their first thing is buy more life insurance. And I'm like, dog, if you need 10 times, and if I'm making 50 grand a year, I would only need 500. Why are you showing me policies with $5 million death benefit? I do not give, how does that make any goddamn sense? So it's always buy more life insurance for whatever reason. how much money should you contribute was something that that I was trying to figure out. And they recommend contributing 10 to 30% of your income.
It's a big chunk for most people.
Yeah. So they recommend, back in the day when they did this, they recommended 10%.
I mean, we've seen budget breakdowns, so like now we do a lot more entertainment, and like food is a lot higher than it used to be. If you look at like old The Richest Man in Babylon, no, The Law of Success. Yeah, by Napoleon Hill. He breaks down like the average man's budget back in the 1920s or whatever. And you can see that like the entertainment portion is way smaller than it is now. So that's why they were able to do this.
Right. Well, and there was a, whatever happened in 1982, there was a reason. Yeah. You know what I'm saying?
Yeah.
So my question was, I was like, how do you guys make money? You know what I'm saying? How does the insurance company make money? And so fees, commissions are worked into the illustration and paid up front at the contracts. So there's no hidden fees in the future, and no one is stealing the profits down the road like a fund manager might, okay? So that was the way it was explained. So like a fund manager, you know, you got your 401k, you get a percent taken or whatever, right, for whatever down the road. So everything is up front with life insurance. So that's a good thing, right, is like, you know exactly what you're getting. It's not, no hidden fees, nothing. You know exactly the amount it costs to pay in. It shows you in all the illustrations. You see exactly like where your money is, period, right? So I thought that was kind of cool, was like there is no commissions to keep the account. There's no fees the longer you have it. When you're done, you're not getting taxed. None of that stuff. And so the last thing I was kind of wondering about this whole thing is like, why is this safe? Okay. So, fractional reserve banking. Do you know what that is?
No.
So, fractional reserve banking was made, I'm not sure the year, but it allows banks that they only have to hold 10% of deposits, and then they can lend out 10 times that amount. So they can lend out $100 per every 10.
Okay, yeah.
Okay. So every dollar the bank has, they loan $10. Okay. Every dollar that the life insurance policy or that gets paid into life insurance or cash basis or everything gets invested at a 1-to-1. So there's no, they have that money tied up in investment or something. It's not like they don't have 1/10 of the money. They have 10/10 of the money or more, you know? And so their whole thing is like, they're giving you a dividend based on individuals dying. So as individuals pass, the cash basis goes to the insurance company. The death benefit gets paid to the individual, right? So if I'm putting $20,000 a year in, $10,000 to premium, $10,000 to cash basis, or $10,000 to my cash basis, and I do that for 30 years, the money I have in my cash basis at the end does not go to you, my beneficiary. It goes back to the life insurance policy, and you get the death benefit. Okay, so what happens is, how they get dividends is the difference. So like when a death benefit is paid out that's less than the cash basis they just received, then that cash basis gets paid out through dividends, as dividends, right? So they're paying that out at like, it ends up being like 3.5%, right? So they just take the money they get from you, and they need to get a better than 3.5% return. So they can invest in certain funds, mutual fund stocks, things like that, investments, to get an 8 to 10% return. And that's where the insurance company makes their big portion. And that's, I mean, so they're essentially trying to make a 5% or more spread. That's where they're making their money. And then, I think the aim is 3% or more. 3% or more, and that's how the companies make their money. And then the agents, the admins, all that are getting paid out of your fees you pay in. So that's how that's how everyone gets money. It's how everyone, work in the business gets paid, and then the actual business gets money through the interest. So yeah, that's why it's safe, is because it's 1-to-1 lending instead of 1-to-10 lending. And that was the main things that I was like wondering about, or like concerned about from looking into this. So it takes a few years to like buy into these policies to make it kind of like worth it, I guess, is what you could say.
Okay, let's like start from the beginning of this whole thing.
Okay.
So you sign up for a whole life insurance policy. How much money do you have to put in right away? Like,
All right, so you sign up for a whole life.
Yeah.
Okay. Now, let's say if you just sign up for a whole life and you just want it for a life insurance policy, fuck the cash basis, you're probably going to get away with like $150 a month.
Okay.
$120 to $150 a month.
You don't have to
you're
put like
younger.
anything down right away,
Nope.
like a big chunk. Okay.
Mm-hmm. Nope. So you could just pay $120 to $150. That takes about 20 years before you have any level of like cash basis, because the whole first 15 years is just paying into premium.
Yeah. So paying like for all the fees and the everything like
Yep.
that. Okay.
Yep.
So if you wanted to start having it as a bank, you can put in just like a big lump sum right away, and they just take out all the premium right away.
Yes, but you can only do up to 10% of your premium. So if you're doing $120 a month,
Mm-hmm.
120 times 12 is 1,440, I think. Is that right?
No. 12 times 12 is 24.
1,444.
240. Because you said 128 times 12, right? So that would be
Okay, so 120
2,400.
times 12 equals 1,440. All right, like I said, so it'd be 1,440. So
12 times 12 is 144, not 24. Wow.
there you go. All right, so I'm over here with fucking math in my brain.
I asked for coffee and you told me no.
All right, so we're at 1,440. So you can put in up to 10 times that amount. So you can put in $10,440 up front.
Oh.
Mm-hmm.
That's it?
That's all.
And then you can only borrow 10% of that? I was talking about like banking. So like if you put in a big lump sum,
Yeah.
when can you start like using it as a bank?
Within the longest is 14
And you
days.
can borrow whatever your cash basis is? Or no?
It's a collateral, so you can borrow up to your cash basis.
Okay.
Yep. So if you 1,440 is your yearly premium,
Mm-hmm.
you can fund in 1,000 or 10,440 right up front. And then I think we figured out that 15% of it gets taken as fees right up front is what we figured out, I think.
Something like that, yeah.
So like 15% is going to be taken right away. So then you'll have 8,500 you could lend on right away.
Yeah. Probably more than that. That'd be, wouldn't 10% be 14,400?
No. Is that what it would be?
You just gotta move the decimal over.
Oh yeah, 14,400. My bad.
15%, so
So you'd have 12,000 roughly.
Okay.
Oh, but that's counting the premium. No, because yeah. So anyways, whatever. Yeah.
So how do they figure out what your death benefit is? Right, so you're saying that you don't get the cash basis, you get the death benefit. So is that just like you sign up for an amount and they give you a monthly premium for that, basically?
Yeah, so you sign up for an amount.
So you could be like, okay, I'm just going to sign up for $1 million death benefit.
Yeah, yep. Yeah, so if you want like $1 million death benefit, there'll be a...
Because I'm assuming they would tell you what you would kind of have to put in, not just like, I only want to put in $150 a month.
Oh, yeah. They for sure do that.
Okay.
Because they'll go, oh, what do you want to pay? And you'll be like, oh, I want to pay
150 a month, and they're like,
150 a
this
month.
will give you this amount of death benefit.
Exactly.
Okay, cool.
Yep.
And I'm guessing it depends on what your age is, on like how.
Age and income.
Okay.
Because you can't just get egregious amount of death benefit if you only make 10 grand a year.
Right. That would make sense.
Yep. So it's all based off of age and income.
Okay.
So boom, boom, boom. Additional premium issue. So yeah, kind of how it's looked at is you've got your so if you just pay in like we were discussing, and you're just paying in right away, you only have to pay in your death benefit. You don't have to do extra cash value with it, but you can, and you can do like I think 50% is what you can do.
Yeah.
Or like so you can match it. So if you're doing 1440 a year, you can also put in 1440 of cash value with it a year.
So I guess we can kind of spoil our. Do you have anything else? Any more?
I'm trying to think if there's anything else. So the big thing is this. You can be your own banker. This is your own banking system. The issue is you're not actually using your money. You're just using your money as collateral.
Yes.
Same exact thing as if you were to put it into a CD. Okay? Which you can go to a bank. So CD, certified deposit. You can go to a bank, lock up your money for 1 year. Say it's 100 grand. You go in, give the bank 100 grand. They give you 3.5% return.
Well, they're like 5% right now, aren't they?
So,
anyways.
Okay.
Sorry.
The one I just got a quote on was 3.5.
Okay, cool.
So I'm gonna lock up your money for a year at 3.5. Okay, cool. I can go into the bank and get a loan, and use that as collateral, and I can get the loan at 2% above. So I'll be paying a loan back at 5.5%.
Okay.
So I go to the bank, get a $100,000 loan at 5.5% instead of the current rate of 8%. It's just 2% above my collateral there. So the bank is making a guaranteed 2%.
Damn.
So that's how you lend on CDs.
Yeah.
Okay. Or that's the whole concept behind banking, right? It's the same exact setup, just with like 70 more steps, and you have to make the payments, and this shit's for fucking life when you do whole life insurance, right? So the only difference between doing a CD and a life insurance is 100 other steps. You lock it in for life, and you have you're getting a lot more fees and shit taken out of.
Yeah, that's really like. Can you pause payments for whole life or no? Like you have to pay those in.
If your cash basis was made up enough, you can take money from your cash basis to pay your premiums. So if we were like gung ho right away up front and drop 100 grand in, and we got our premiums and whatever, we could then steal from our cash basis to pay our premiums for the next 10 years.
So that's that's kind of crazy that whole life was such a big thing, because I guess if you can pay your premiums while like with using it, that helps. But I feel like so many men like back in the day were salesmen, so their income was never guaranteed.
They had to be good at selling.
So it's just like interesting to think about. So do we want to kind of explain like why we looked into this and like what our thought process is?
Yeah. So the last part about this is as we were like researching this a lot, and I was talking with Ryan and stuff, and this was something you and I have been doing, and we're thinking about, we were like, wanted to compare it to, was why you wouldn't just be your own fucking banker.
Right.
Put your money in a high yield savings account like Ally, American Express, Robinhood, whatever, where you're getting, right now, it's high. Right now, it's at like 4.5 for Ally, 5.25 for Robinhood. You know, whatever. That's your return you're getting. Why wouldn't you just put your money there, lend it to yourself, pay yourself an interest rate, 8%, the market value, and you pay that interest rate monthly back into your account, and then when that's paid off, you put that back into your high yield savings account, right? And so like just literally you being in control of everything. why would you not be your own disciplined banker out of a high yield savings account? And what we figured out is that is the option.
Mm-hmm.
That route, I'm going to try to pull it up. Go ahead on why we decided to do this.
So one of the things that, like, Shaun and I aren't big spenders. We've talked about this before. We have 3 or 4 different savings accounts that we put money in, and like Ally is one of them that we don't open. We don't look at it, so we just forget the money's there. So every month we're gaining interest on it, which is awesome. So I think like last month we gained, I think it was low, but it was like it was like $300 or $400 on just our, and then we quadrupled the balance this past month, so that'll go up substantially. But we like the idea of being able to have access to our money at any point in time. So, I mean, it takes 3 days to transfer money from Ally, but if it's like for a down payment of a future flip, we know when that date's going to come up that we're going to need that money, so we can transfer it, and we can lend it to our own business at 8%, 10%, whatever.
Yeah, 10%.
So yes, we're not getting the interest in Ally at that point, but we're still gaining
10% interest, so over double the interest.
Right. And then once that flip sells, then we pay it back into our Ally account with the interest. So we just like the idea of the flexibility of being able to access our own money whenever we want. It makes me feel better. At one point, Shaun had a 401k, a Roth 401k, and he just let, like, I don't even think you guys, like, had someone that was doing the account for you.
No.
But they just sign you up for the regular funds, whatever. And Shaun was looking at it, and he's just like, these are terrible funds to be in right now. And so he personally went in to switch what funds his money was getting invested into, and ended up doubling his account within a couple of months because Shaun did the work, the appropriate work of putting it in the correct funds that were actually increasing.
Right.
So yeah, just being able to control our own money and putting it into things that we are guaranteed a better return than 2%.
Right.
And then we were looking at, we made a document. The insurance agent we were talking to, he gave us a spreadsheet of like how much we'd have to put in every year and then what like our cash value would be. And so we were looking at it to see like when we would not break even, but like what the cash basis would actually be at. So we lost money on how much money we would put in for the first 4 years, I think it was. And then we started then we started gaining more than what we were putting in.
Yeah.
So like our thing that we were looking at was like because we wanted to be able to start using it as a bank right away. So we had to put in a big lump sum, which meant that every year we'd have to put in $20,000 into this account, which like Shaun said, you can use your cash basis to pay your premiums if you can't afford it, so whatever. But looking at it, like I think the first year, like we would put in, because of fees, we'd had to put in like $21,000 the first 10 years. And the first year we would lose like $5,000 right away. And then it dropped down pretty good. But it wasn't until year 10 that we made back all the money we had lost. Right? Or was that the first year that we finally made more than we put in?
Year 14.
14?
Year 14.
Okay, year 14 was the first year you would make more than you would put in. And we also compared it like once you have the dividends as well. And just looking at it, by year 10, we're able to make more money from a high yield savings account. So if we just put our money into a high yield savings account and added the same amount as we would to the whole life insurance, we were, and I think we did 3% too on a high yield savings account was one of the columns, and we were still up like $10,000 or $15,000 in the high yield savings account versus the whole life insurance policy. And that's so it's not including it lending it to our own business at 8 to 10%. That was strictly if we just put in a lump sum and then added the $20,000 a year and the interest that we would get from either the whole life or the high yield savings account.
All right. So what we got going on here is we did we broke it down into a 5%, a 5%,
4%,
a 4%, a 3%, and a 0%. Okay. So you're guaranteed. We'll base it off of the 14th year because that was our break even, right?
Mm-hmm.
So you're guaranteed $309,000 at year. Sorry, so we'll do year 14. So you're guaranteed $291,000. Okay, that's what you're guaranteed.
And that was with us starting to put in 111,000 the first year.
Mm-hmm. Yeah, that's what's starting with 111,000 on the first year.
Yep, and then 21,000 for the first 10 years, and then to 20,000 after that.
So at our year 14, our guaranteed, if we just put money in but never got a single percentage, if this was just a straight savings account, nothing but a savings account, okay, we would have $382,000. So we would have $91,000 more if we never got a single dividend or interest payment for the life insurance or our savings account. We would be up 90,000. We'd be up 90,000. Okay. Now let's go based off of for funsies. Their total net cash value of year 14. Boom. So what your total cash value would be if we got our 3.5, our average dividend, it would be 443,000. Okay, 443,000.
Wait, for what? Sorry.
So for our life insurance policy, if we were to put our 111,000 in right away, and then 21,000 for the next 10 years, and 20,000 after that, so that would be $443,000 is what we'd have at year 14, our break even, right?
Mm-hmm. With the dividend?
Yep, okay. With the dividend. And we come over and we just look at our 3%. So what would it be if we have a 3% return? We would be at 452. So we would be up $10,000. So we'd be up $10,000. The next year we would only be up $3,000. And then the following year we would be down $5,000. So if we're getting a 3% return, our break even or our reverse is somewhere between year 15 and 16 at 3%.
Mm-hmm.
Now if we go to 4%, we would be at 481,000 compared to 443, so we'd be up 40,000.
Mm-hmm.
And our year where we start to make that transition would be year 16 for that, where the other policy starts to take over. And at 5%, we'd be year 14, 511 compared to 440, so we're up 70,000. And our break even on that guy is significantly different. Where's 20? 1 sec. It's just
it's down there.
It's cruising down there. So what's this one? 759. Okay, nope, it keeps. I don't have it. It doesn't go down far enough. But it's just
So it's over 30 years.
I dragged it down for 24 years, and at 24 years, we're still up. we're still up by 10,000.
Okay.
So it must be around
Year like 26, 27.
year 26, 27.
Yeah.
So 5% is kind of a lot to whatever. But the way I look at this whole thing, right, is, you know, in neither way, the high yield savings account nor the life insurance are you guaranteed anything. You're not guaranteed an interest payment. You're not guaranteed a dividend. Okay.
Right. I mean, if we think back to 2020, it
was
was
a 0.3.
Yeah.
It was a 0.3. So yeah, I mean, you don't nothing, right? This is what they don't take into account. Okay. We can lend to our own self at 10%. Okay. And at 10%, we can get our money back and pay into the account and save that 10% interest. Okay. We can also take that money and tie it up for 3 months, 6 months, 9 months, and year contracts with hard money lenders at 8%. So if we got stagnant money, we can tie it up at 8% at any point in time. And especially those ones, you can just say, yeah, fucking recycle the interest into it and keep lending on that money, right?
Yeah.
So even with accounting for, guys, so we even accounted for getting taxed 30% on our gains.
Yeah.
Which I think it might just be long-term capital gains. I'm not sure. It might only be 15%.
I don't know.
But anyways, we accounted for our interest payments. No, I think interest payments are around your regular. So we averaged 30% being paid in for interest, for taxes. And then rolled that into the next year, rolling year 70% gain, to keep compounding. So what I figured out on life insurance is this. Whatever happened in 1982 was not great for the life insurance community. If you are responsible, I don't think whole life insurance is for you at all.
But if you're a money spender.
If you're a money spender and you need something that says like, and you need somewhere to put your money or whatever because you cannot control yourself and you just need monthly payments, I think whole life insurance is the best thing you could do, because at least that way you're not fucking your beneficiaries. And that way they'll at least have your death benefit to pay off your dumbass spending.
Yeah.
So from what I've I've tried this twice now. I've tried figuring out if life insurance works twice now. And if you're responsible, I cannot fucking get this to pencil out unless you're cool with your investment breaking even in 16 years. If you're cool with an investment, and this isn't an investment, it's a bank, but you can be your own better banker. That's the thing I want to stress here is they say that becoming your own banker, the infinite banking system, the problem is you can be your own better banker out of a savings account. So why the fuck go through all this hassle and do all this shit when you can be your own banker? You're just giving away money. 16-year break even. What? Be your own banker then.
Yeah.
And so, yeah, don't use it as an investment tool. It's the worst one in existence.
But like we said, if you are bad with spending money
and you need to just put money somewhere so you have a death benefit and you might have a little cheddar down the road, this is a phenomenal idea for you.
And Shaun and I were talking about it, like, this is honestly something that's probably really good for 80-70% of the population right now.
Honestly, yeah.
Because the population is a whole bunch of spenders, not savers. But the other thing we talked about is right now, like, a lot of people are working paycheck to paycheck, so they probably don't even have any extra money to throw into an account like this.
Right.
Like, they'd be better off putting money into a high yield savings account as well.
I think so. Yeah.
So that's what we got on Whole Life.
Hope you guys enjoyed it. Hope you learned something. And catch us on the next one.
See ya.